Welcome to Markets Now. I'm Michelle Rourke with Ken Beadle of Paradigm Futures, and we're seeing quite a bit of green on the board here this morning, both grain and livestock futures, even cattle, which opened with a little bit of weakness. But Kent, let's start off talking about the corn market. USDA gave that market a shock, a bullish shock yesterday with a 200 million bushel decrease in ending stocks. We're right up into resistance. Do we have enough of a tailwind to get us through those areas and close above those areas, do you think?
I think that we will have enough tailwind, but I don't know that it's going to happen today. All right. I think that we've uncovered some selling from the U.S. farmer. I think they've been waiting for $4.50 a bushel. You mentioned the resistance. We have the old highs from October at 52 and a quarter, and we have the 200-day moving average at 51 and a half. And we tickled those areas this morning. And as I say, we've uncovered some farmer selling. The underlying fundamentals still look very good to me. We are still inexpensive. Corn is still cheap to the end user. It still has value into livestock. It still has value into ethanol. And obviously, world exporters or world importers and domestic users all know that these are still prices that the farmer cannot actually make money on. And so essentially, our balance sheets have put corn on sale now for the better part of a year. And end users are taking advantage of it. And that's why we saw the demand go up so much on the report yesterday.
Do you think we're going to see more increases in demand as we go forward, as long as we keep, at what level do you start being not competitive?
Yeah, exactly. The competitive side of it, keep in mind your next year's safrinha corn crop is going to be, not planted here until February and not harvested until, June or July. So, we could end up competing with that a little bit on the back end of the cycle, but a lot's going to be determined by whether that crop is any good or not. And we just don't know the answer to that question. Meanwhile, we are very competitive and we've been selling a lot of corn. On the other side, domestic livestock demand, of course, we just continue to see higher cattle and hog prices, or we continue to have strong cattle and hog prices, and we see good margins using corn into that source of demand. And obviously, ethanol margins and have been reasonably good, and ethanol exports have been excellent because we've been uncovering new markets for ethanol, including Canada. We hear about Japan possibly picking up more ethanol from us, and we've been obviously good sellers of ethanol seasonally at different times into Brazil. So, whether or not we can continue the strong demand pace, we would look at an objective of somewhere in the neighborhood of $4.80 as being a reasonable objective for where this market could potentially peak out.
Okay, so we don't have a lot more upside here, is what you're saying, basically. So.
Obviously, depending on what weather does around the world going forward, right?
Right. All right, so soybeans got a little bit of help from the corn market, obviously, yesterday, because USDA left balance sheets unchanged for the U.S., which almost to me was a gift, considering what we know or what we think we know about what we may have for tariffs and how that might impact exports going forward. But let's talk about the South American crop, because USDA raised that crop just a little bit in Argentina, but it's still pretty early, isn't it?
Yeah, it's early. They raised the Argentine production based on additional acreage, not on yield or crop condition prospects at this point. Argentina is got some good areas, and it also has some areas that have been on the dry side. Way too early to determine yield in Argentina as of yet. I still think it's too early to determine yield in Brazil as well. Okay. That crop was planted very constrained, or in a very tight planting window, and harvest is going to be in a very tight window between the end of this, the end of January into February, yield is going to be determined by the amount of rainfall they get in Brazil in late December through the month of January. And, rainfalls have been plentiful. And if that continues, they're going to have a really good crop. If that doesn't continue, there is still plenty of threat to the size of those yields. Just go take a look at a map from NASA and the Grace Root Zone soybean moisture maps, for example. Much of the northern part of Mato Grosso is still on the dry side relative to average. I don't believe those soils hold water as well. They're going to need to have continued rainfall in order to reach the kind of yields that many people are projecting.
Well, we'll see. Last year we had worse drought than this at the end of the year in South America. And obviously when they started getting rain the first part of January, the market just kind of crumbled. So we'll see how long we can hold this market together with that in mind.
Could I make one point, Michelle? The other big concern about soybeans is the potential for tariffs. And I just want people to understand that at the worst of the situation in 2018 and 2019, soybean prices at their worst were between $2 and $2.40 underneath cost of production. And we are approximately $2 underneath cost of production right now. Okay, so I realize that many people are looking at soybean with an 8 or a 7 in front of it because of South American production. But, I just have to say we're already historically cheap.
Okay.
And I don't believe that we're going to plant many soybean acres, or we're going to have a reduction in soybean acres this spring if prices go to where some of the analysts believe they're going to go to.
Gotcha. One other thing, I don't know if you can cover it quickly or not because it's kind of complex, but we had some adjustments in terms of soybean oil production and crush, and we've had strong exports. What did USDA do with that?
Yeah, so what they did is they took a look at the soybean oil yield in the first 2 months of the marketing year here, September and October. Those soybean oil yields were up 0.2% in September and 0.9% in October, and they raised soybean yield on the balance sheet up 0.7%, which gave them an additional couple 100 million bushels of soybean oil production. Okay, now they raised exports by 500 million, and one of the things they did is they lowered domestic use, so food use and other industrial use, by a couple 100 million pounds. And that's probably the place that I argue with. Now, they did not reduce soybean oil for biofuels on the balance sheet, but they did reduce domestic use. And I would just say that soybean oil prices right now are cheaper than a year ago, and yet they're over 200 million pounds less than what we used in salad oils and the like last year.
Sure.
So we're not rationing demand at this price in soybean oil. That may be something they're going to have to readdress in the future.
And wheat is seeing higher prices again this morning. Is that market still digesting the lower ending stocks from the report yesterday, or do you think that this is just some short covering?
Oh, I think it's partially short covering. I don't doubt that. Wheat has been the short leg of just about every spread now for weeks and months.
True.
I do think that, you have a couple of strong fundamentals. U.S. wheat exports are still nearly 30% ahead of a year ago. That's why they raised exports on the balance sheet yesterday. We still have questions about the conditions of the Russian wheat crop going forward. The answers to those questions are not going to come for quite some time, but it is worth understanding that in the eyes of many, that's one of the worst crops, or worst start to a crop that the Russians have had in quite some time.
No doubt. Cattle market, we're a little higher again this morning, but we're getting up into resistance areas right at the same places where we hit resistance in November. We've had some steady cash, maybe even a little bit better at 191 so far. Do you think, do we have enough momentum to get through those areas?
Initially, probably not. I think what we will do is uncover some hedge selling, and once again, I think that these are obviously good levels for cattlemen. Now, our, what I call cattle crush margins, corn plus feeder cattle prices into live cattle, those margins have come down quite a bit. But for those cattlemen who have their corn purchased already, these are probably pretty good hedging opportunities once again.
Gotcha. And of course, the hog market is kind of consolidated off of its recent contract highs, but the funds are still record long there. Do you think we're going to see a bigger correction than what we've already seen? I mean, is this healthy so far?
It is healthy. And I've been looking for a correction in hogs, as have most people in the industry now for quite some time. It's just going to be a question of, what does the next hog and pig report say? How do cash markets continue to hold together? Obviously, we've seen, fairly solid demand with the large discount of pork prices to beef. Clearly, there's been a lot of concern about production as of late. We've started to slip below year-ago levels on a weekly basis in our slaughter, and a lot of that seems to be tied to worries about disease pressures from PRRS. So, we have some great margins out there for hog producers to lock in, and I think they've been taking advantage of that here recently. Whether or not the cash markets are able to move lower in conjunction is something we're going to have to wait and see.
I know we've been considerably strong for this time of year, though, so hopefully we can hold things together.
Yes.
Yeah.
Yes.
All right. Thanks so much, Kent Beadle with Paradigm Futures. Remember, futures and options do have substantial risk. This is Markets Now.